Hello, everybody. If you're here, I believe you are studying management of markets, management of investments, portfolio management, or you are somebody who is in the commerce field. Today, I want to speak briefly about market efficiency using the efficient market hypothesis. So, in this small video, we're going to talk about what makes markets to be efficient, what makes markets to be less efficient, what makes markets to be strongly efficient, and many other things that can help us to be able to understand uh, what makes the decision to decide to buy assets, to decide to buy stocks or not to buy. So we're going to look firstly by explaining what makes a market to be able to be efficient. So when a market is efficient, new information that comes into the market should be able to reflect quickly on the prices of stocks. So if stocks or or assets react quickly to the arrival of new information, then we can say that that market is very efficient. But also, it's not just only new information. It can also be past, the combination of past information, public information, and also access to private information. So for example, there's a leak of information from a boardroom of a certain company that is regarded as private information, because the intention of that wouldn't be to leak that information, but the fact that that private information is now in the public domain, that can have an effect in terms of how prices can reflect, how prices can change, and that can also impact in terms of decisions of investors to whether to buy or not to buy certain stocks. So the quickness of reflection of information on prices is one element that that we use to determine whether the market is efficient or not. So if there's if a market is highly efficient, so which means that there's speed at which prices adjust as investors access to information. If we can so we know that investors believe that if a market is highly efficient, they'll accept that market prices are a true reflection of the intrinsic value of entities. So the intrinsic value is things that are not publicly known, but things that are also important in terms of determining the prices of a stock. But also in terms of the decision to buy, whether there is quickness of information. To decide to buy, you should also consider in terms of the costs of making the transaction, because we know that brokers charge costs whenever we buy and sell stocks. So those costs are also very important, and also the cost of acquiring that private information. If it's very high, then we can't say the market is efficient, because it's difficult to access private information. But if private information is very accessible, and if it's possible for us to be able to access private information, then we can regard that market as very efficient. But I've spoken to these factors, I think, in my initial presentation. So we have things like the time it takes for prices to adjust to the arrival of new information. That determines whether the market is efficient or not. If it takes longer for prices to adjust, then we can say that the market is not efficient. If it's quicker for the prices to adjust, then we can say the market is very efficient. But you should also know that markets that are highly efficient and markets where prices adjust quickly are markets that are highly developed, right? And in developing markets, then it might take longer and for prices to reflect the arrival of new information. And obviously, we've spoken about costs of acquiring information. We've spoken about costs of doing the transactions of buying and selling these stocks. That also determines whether a market is efficient or not. And also the aspect of the relationship between market value and intrinsic value. If there's a disparity between market value and intrinsic value, and so the intrinsic value, we're able to observe that by looking way beyond what the market is giving us. So if there's that disparity between those two aspects, then we can say that the market is very efficient. If we're able to get the information and prices reflect quickly, then we can say that the market is efficient. But so we have got three forms of market efficiency. We have got what we call weak form market efficiency. So in the weak form market efficiency, this is when an investor has only access to past trading data. So you only have like probably data for the past 5 to 10 years, but you don't have data for probably the current period, and you don't have enough predictions for the future. But so you only have access to what has happened in the past. So and we know that this past data, this past information is already reflected in the current prices, and you cannot use that to predict future prices. Um, so also because yes, in this past data, we have access to what has happened before, but we can say that there is no enough serial correlation to create a profitable trading rule after considering obviously cost of transactions. What is serial correlation? These are relationships between either information and prices. So if there is no strong relationship between information and prices, then it becomes very difficult for us to be able to predict the future. But if there is a high correlation between information and market prices, then we can argue that there is a high serial correlation. So once there is correlation, obviously correlation doesn't mean causation. But obviously, correlation gives us how strong the association between information and prices has been. So, since we only have good past data, we do not have enough evidence of a strong association between information and prices. But because we've got past data, we can use technical analysis where we can create graphs, we can create trends and try to make sense out of those trends. And if we see some correlation, then that can help us to be able to make some decisions based on those correlations. But we don't have enough information for us to be able to make profitable decisions. But of course, there are opportunities to make abnormal profits when the market is weak form. That is if you have managed to make sense out of those associations between information and market prices going into the future. But it's very difficult because you can't always rely on market trends. But if there are certain scenarios that may seek that seeks to, or that look like what has happened before, then you may use that as a basis to confirm the trends, and as a result, then decide to buy. Then in a semi-strong form, this here now you have two forms of information. You've got past, what we know from the past, and we also have data or information that is in the public domain. And unlike in the weak form where you have only past, here you now have got public information. So you can use what we call fundamental analysis, where you make sense out of data. You are able to use economic indicators like economic growth. If the economy is growing, you'll be able to make sense of what may happen in the market. So if the economy is growing, you may predict that people are going to make money. When people are going to make money, people are going to spend money, depending with the sector. If increases in income is going to lead to increase in consumption, then you can suggests that probably the people can buy more properties, people can more buy vehicles, people can go on holidays, people can consume more goods than they did before. So this can help you to be able to determine whether the stock that you want to buy is likely to grow as a result of the growth of the economy in its entirety. So, and also because you have access to public information, you are able now to predict the intrinsic value of the stock. And if you find that the intrinsic value of the stock is lower than the market price, then um then you'll be able to decide whether to buy or not to buy. So you have that access of information is going to help you to be able to decide. Then lastly, we have what we call strong form market efficiency, where you have access now to past data, public data, plus private information. So this private information, if it is affordable for us to get it, then we can say the market is efficient. So obviously, once you can access that data, it means you can afford that data. And once that is in the public domain, or once that is in the hands of most investors, then we can argue that we the market is strong form efficient. So the difference maker now between um, the semi-strong form and strong form is the access to private information. So that's what determines the decisions to be able to buy, or to be able to predict how market prices are going to prevail going into the future. I hope what I've explained um, is able to help you to be able to understand, the um, efficient market hypothesis, and also understanding how important, different kinds of information, uh, is to investors, in order for investors to decide, when to buy and which stocks to buy. So I hope I've managed to help you clarify some issues. Thank you very much.